Hello and welcome back to AQA Accounting Teacher. I'm just recording a quick video about the statement of financial position using the new layout. New in inverted commas, it's not really that new, but whereas the traditional balance sheet is built on a layout of assets minus liabilities equals capital or equity, the more modern version is to take assets, total them up, and then add equity or capital plus liabilities to get a total there. So we're just going to run through that. So a lot of the material is the same, quite similar. So hopefully some of this you'll already be able to do if you've watched the video about the income statement and maybe the one about the old balance sheet or statement of financial position. You're already going to be able to distinguish between assets, liabilities, income and expenditure. If you can't, if you have no idea what those are all about, then probably go back and look at the income statement video. You should be able to differentiate between items that need to appear on the income statement, so that's your income and your expenses, and those that are going to pop up on the statement of financial position. So that will be assets, liabilities, and anything to do with the owner's capital. I'm going to show you how to draw up a list of, draw up a statement of financial position from a list of balances, and then hopefully by the end of all this you will be able to assemble a complete set of financial statements using a trial balance. Okay, so a reminder about the accounting equation. It's assets minus liabilities equals capital, and that forms the basis of a more traditional balance sheet. So if you're studying business studies, you might know it as the balance sheet, particularly GCSE. But we can rearrange that formula to say that assets equals capital plus liabilities, and that's going to form the basis of our more modern statement of financial position. Okay, so in terms of where everything goes, the income statement, you should already know this, deals with income and expenditure, and it shows us how much the business is earning from its trading activities. So income minus expenses is going to give you a profit. That's the surplus of income over expenditure, and obviously if your expenditure is greater than your income, you've made a loss. The statement of financial position though shows the value of the business at a particular date. It gives a snapshot of the value of the assets, the liabilities and the owner's capital at a particular date, which is usually going to be the year end. So whereas the income statement encompasses transactions for the entire year, so we say it's for the year ended 31st of March 2024, the statement of financial position is going to be at a particular date, so as at the 31st of March 2024. And if we were to draw one up a day later, it would all be different. So the non-current assets will probably be largely the same, but all your current assets are probably going to be changing 2 or 3 times a day. Things like inventory, trade receivables, bank balances, and so on. So this is what a statement of financial position looks like under the new layout. We list the non-current assets at the top. So those are in it's a 2-column approach generally when we haven't got depreciation to worry about. Non-current assets, top right there. Then we add in the current assets, and a way to help you remember the order of those is this the best college? A little bit later on we'll be adding in prepayments, so we can say is this possibly the best college? So we just put the values in there so we can see Tara's non-current assets at the top there, 120,000, and then her current assets, her inventory, always closing inventory on the statement of financial position, so that would have come out of her income statement, deducted from cost of sales. She's got trade receivable balances, those are the customers who owe her money. She's got money in the bank and she's got cash. So the total of those current assets, 26,500, and when we add it onto the non-current assets, gives us a total of 146,500. And all of these are going to be debit balances on the trial balance that aren't expenses. The expenses will have already been carted off to the income statement. So on the debit column, we should just be left with assets and the owner's drawings. And we move down to the bottom half. So what we're aiming to do is prove that capital plus liabilities equals the same amount as this figure, the 146,500. So we start with the opening capital. So this is at the beginning of the year, and in Tara's case she had opening capital of 75,000. We've already done the income statement, so we've worked out that she made a profit of £12,000 for the year, and then we're taking off her drawings, that's the money she's paid to herself, £7,000. So her closing capital is £80,000, and of course that will become opening capital at the start of her new financial year. Then we're adding on any non-current liabilities. So in this case Tara's got a bank loan, something that's going to be paid after more than 1 year, £50,000, and then she's got current liabilities. The only thing she's got in there is trade payables, money that she owes to her suppliers, but if she did have a bank overdraft that would go alongside there. So total of current liabilities 16,500, and when we add the 80,000 of capital, the 50,000 of non-current liabilities, and the 16,500 of current liabilities, we get to a total of 146,500. So overall, these are all credit balances. The only debit one sneaking in there is the drawings figure, but everything else will be on the credit side of the trial balance, things that aren't income. So income, sales revenue, anything received, past tense, so commission received, bank interest received, rent received, that's all gone off to the income statement, and that's been used in working out this £12,000 profit for the year. Okay, so let's have a look at one now. We've got Mike, who we need to draw up a statement of financial position for, and we've got a trial balance here. Someone's already worked out the profit for the year, that was £18,000. So everything else we're left with should be either assets, liabilities, or something to do with the owner's capital, either capital itself or drawings. Now the starting point for this, I think, is to actually look down and make sure you can identify what all these things are. So anything in the debit column, remember, is going to be an asset. So cash at bank, cash in hand, those are current assets. We've got trade receivables, also a current asset. We've got the owner's drawings. We're going to deduct that from capital, so that's not an asset, it's a deduction from the capital balance. We've got equipment, which is a non-current asset. We've got inventory, this is closing inventory at the end of the year, £5,000, that's a current asset. And then vehicles, that's another non-current asset. And if we look down the credit column, we've got a bank loan, which is a non-current liability. Trade payables, money owed to suppliers, that's a current liability. We've got profit for the year, we're going to be adding to the owner's capital. We've got the opening capital, £45,000 at the start of the year, and then the totals here for the trial balance, so 97,500 on each side. So from that, we just need to slot those in. So it's just a case really of learning the layout. So you might want to take a photo of that so that you can see how the layout should look. So we've got non-current assets top right, then we add in the current assets, list those in the left-hand column. So again, the left-hand column is providing the detail generally, the right-hand column the headline news. So the total for those current assets, 19,500, which we're adding to the non-current assets to get to total assets, 85,500. And we're going to prove then that those assets equal the total of Mike's capital plus his liabilities. So his capital is down here. We've got 45,000 at the start of the year. We're adding the income statement figure, the profit there for the year of 18,000, deducting the drawings of 12,000. So the value of Mike's capital account, his investment in the business, is 51,000 at the end of the year. Then we're adding non-current liabilities on. We've got a bank loan, just one non-current liability, bank loan of 25,000. And current liabilities, the most common things we find down here are trade payables and a bank overdraft. Well, he hasn't got an overdraft, he's got money in the bank up here under current assets. So we're just adding in these trade payables, and when we add those three things together, the 51,000, the 25,000 and the 9,500, his total capital and liabilities amount to 85,500, which is the same as the total assets figure. So we've proved that assets are the same as capital plus liability. So the assets are debit balances, capital and liabilities are credit balances, one minus the other comes down to zero, which is as it should be. Okay, so I'm going to let you have a go at one now. Here's an extract, some figures for somebody called Shah. This is at the year end 31st of March 2024. So what I'm going to suggest you do is pause the video with that on the screen. Have a go at drawing up the statement of financial position. Hopefully you've got a photo of Mike's one or Tara's one that you can refer to. So try and slot all of that into the right place, and then when you've had a go at it and you've got it to balance, come back and we'll have a look and see what it should look like. Okay, so spoiler alert, I'm going to reveal the answer now. This is what Shah's statement of financial position should be looking like. So her total assets are 46,125 and her total capital and liabilities are the same amount. So just have a look and check that you've got things in the right place. You've started with your non-current assets, then you've listed your current assets, and if you could just get into the habit of remembering the order of these, is this the best college, inventory, trade receivables, bank, cash, just makes life easier and reduces the chances of you missing something out. Add those two together to get the 46,125, then sort out her capital account, what was there at the start, add the profit minus the drawings, and then we can add in the current liabilities. So we've got trade payables and we've got the bank overdraft, 7,250 in total. Add those two together and we've got 46,125, which is the same as our assets. So hopefully you got that one right, or if you didn't, you can see why. So a quick review of this video. Are you now able to distinguish between assets, expenses, liabilities and income a little bit better than you could before? Are you able to differentiate between the items appearing in the income statement and those that are going to be on the statement of financial position? Were you able to draw up that statement of financial position from a list of balances? And do you now feel confident to assemble a complete set of accounts? So having watched the income statement video, now the statement of financial position, can you do the whole thing? Obviously you'll know how good you are. Maybe you need to have a look back at one of the other videos, or maybe watch this one again. But above all, you just need to practice. You need to get your hands on some examples and just keep practicing until you can do this almost in your sleep. It's a really key skill. I can't stress that enough. If you can't master the layouts of the financial statements, there's no point really continuing with any further studies. This layout forms the basis of accounts for sole traders, for partnerships, limited companies, PLC companies, all of it. So you really do need to learn how to do this, be able to reliably draw up the financial statements. In an exam, it's unlikely that you'll get the whole thing to do. It might just be an income statement or a statement of financial position, or maybe even just an extract from one of those, just part of the income statement or part of the statement of financial position. But you need to be able to put the whole thing together. And then once you've mastered the basics, you'll be able to deal with adjustments like accruals and prepayments, depreciation, all kinds of exciting things like that are yet to come. Anyway, good luck with it, keep practicing, and thank you very much for watching.